One of the big things that we're watching for between now and the Fed meeting is going to be retail sales numbers. If there's concern about the strength of the economy, strength of the consumer, that's going to potentially push the Fed to maybe be a little bit more dovish in terms of their language. They're not going to change their rate cut at this point. It's only 25 basis points. But they kind of moved their language a little bit more hawkish at the last meeting. So if we see some weak economic data, kind of expect that language to come back to be a little bit more dovish. Here's what you need to know before the bell this morning. The market came down yesterday, touched the 20-day moving average, bounced off that. We're going to test it again today at the open. Again, it's going to be important to see if the markets can kind of hold on to this level. This is kind of that running trend support that we've had now, really kind of going back for the last couple of years. The market tends to run right along that 20-day moving average. When it cracks it, that's where you get these little short-term tests of the 50 or the 100-day moving average. But that's been really the overall kind of trend of the market now. Again, going back to October of 2022, there's only been one occasion really in the last 2 years where the market even approached the 200-day moving average, and that was back during the yen carry trade blow up in August. We had that 8.5% decline. But outside of that, the market tends to really kind of just continue to remain contained in this kind of upward trend of the markets, staying between the 20 and the 50-day moving average for the most part. No real risk here at the moment, as we've talked about, just kind of really going into the end of the year. We're about halfway through a correction, at this point. So again, the market's got probably a little bit more work to do to finish working off some of this overbought condition. We are very close to triggering a sell signal. We'll do that today, most likely. And again, that just suggests that that doesn't mean that markets are going to have a big decline. It could, but usually doesn't mean that. It just means that upside is likely limited. So we might see a little bit of the market being capped here for the next week or two as we kind of work through the holiday shortened trading, etc. And as we talked about before, markets tend to do better between the post-Thanksgiving holiday and about the second week of December. And then we get into mutual fund distributions, then you get your year-end rally, for the Santa Claus rally. So again, kind of expect some volatility here, expect a little bit of chop. Not a whole lot to really worry about. We've got the Fed meeting December the 18th. That's expected to be a 25 basis point cut. That's kind of where the risk lies. In terms of, if they kind of come out and become a little bit more hawkish here. But again, with oil prices remaining suppressed, that's going to feed into inflation. That's likely going to keep inflation kind of tamped down right now. One of the big things that we're watching for between now and the Fed meeting is going to be retail sales numbers. If there's concern about the strength of the economy, strength of the consumer, that's going to potentially, kind of push the Fed to maybe, be a little bit more dovish in terms of their language. They're not going to change their rate cut at this point. It's only 25 basis points. But they kind of moved their language a little bit more hawkish at the last meeting. So if we see some weak economic data, kind of expect that language to come back to be a little bit more dovish. And that could be supportive of markets through the end of the year. But again, that's mid-December, and that'll be just past the mutual fund distribution. So I'll be kind of setting us up for that year-end Santa Claus rally. So just kind of something to pay attention to. Outside of that, markets are fine. We had talked about previously picking up a small position, a starter position in small and mid-cap stocks going into next year. They've had a nice decline coming back down to the 20-day moving average as well, just like the markets. They had a big spike. They've pulled back here a bit. So again, probably getting a much better opportunity here, but it needs a little bit more time to kind of process here. But again, kind of working off that big overbought condition we had, coming back to support as well. So again, kind of give this a little bit of time, but I think you'll have a little bit better shot at adding a little bit more small and mid-cap stocks to the portfolio for as we move into 2025. And again, just kind of watching that business sentiment. That's what you need to know before the bell this morning.